If you watched the last video, you know I think about capital in terms of jobs. One of those jobs is predictable income. That's where a lot of private credit and structured real estate deals live. And almost every one of those deals will include something called a preferred return. 8%, 10%, 12%, 15%. Here's the problem. Most investors see that number and think it means something that it does not. The assumption I see constantly is this an 8% preferred return. This means I'm getting 8% a year. That's not what it actually means. A preferred return is not a coupon you clip. It's not a promise. It's not a floor for your returns. All that it means is that it's a priority. It tells you who gets paid first, not whether there's actually money to go pay that return. You're just first in line for money that may not exist. Okay, let's make this more tangible. You put $100,000 into a real estate deal. The deal itself has an 8% preferred return. What it means, before the sponsor takes their share of the profits, you need to receive your $100,000 back plus 8% per year. So on a 5-year deal, that's roughly $140,000 that has to come back to you before the sponsor meaningfully participates in that upside. That's the theory. But this is where investors get tripped up. The 8% can show up in two very different ways. Current, meaning that you were getting checks along the way, monthly, quarterly distributions, meaning that the asset itself can pay for enough cash flow to go distribute. Or it's accrued. It's accumulating on paper. That means you'll get at the back end when an asset sells, maybe. A current pay pref on a stabilized apartment building feels like income. An accrued pref on a ground up development is much more so a promise on an outcome that you have to hope delivers in long term. The timing of the pref often matters more than the actual size of the pref itself. Here's something most investors don't realize, right? The waterfall really matters. A preferred return can't exist on its own. It sits inside a broader structure called a waterfall, and all waterfalls are not the same. The waterfall determines the order of operations, who gets paid, when, and how much, and that order can significantly vary from deal to deal. Let me show you the two common structures. Structure A. First, it's pref, then return of capital, then the sponsor participates in their portion of the profit share. This is what most investors assume they're getting. First, you receive your pref, then you get your original capital back, only after does the sponsor take their portion of profits. This structure is more protective for investors. Your whole, principal plus pref, before the sponsor sees their upside. Structure B. Pref, then that profit sharing split, then the return of capital later. This is more common than people think, especially in deals with ongoing distributions. You receive your pref along the way, but then the profits are split between you and the sponsor before your capital is totally returned. You might be getting your current pay in 8%, and the sponsor is taking 30, 40% for everything that's above that, even though you haven't gotten your original investment back just yet. In structure A, the sponsor waits until you're whole. In structure B, the sponsor participates in the upside while your capital is still at risk. This is why I say you can't evaluate a pref without understanding the entire waterfall structure it lives in. The headline number is just one of those pieces. The structure determines how that ad number actually plays out. And what I've learned about higher prefs, here's what I noticed over the years. When a deal is advertising a very high preferred return, 11, 12%, sometimes higher, I'm not necessarily always excited. It can also be suspicion around the deal itself too. Think about from a sponsor's perspective, they're giving up economics. They're promising you a higher hurdle before they get paid. Why do they do that? Usually it's because they have to, or the deal is riskier, or the asset is less proven. The market itself is more uncertain. They need to offer more attractive capital. The alternative side of this too is that if they're taking a higher preferred return to investors, they may keep more equity behind that deal too. So it's not always a this or that. Understanding the full intention behind it is that they may give themselves more upside by giving you a higher hurdle to go hit for yourself too. And a high pref at times is often compensation for risk, not protection from it. I see investors chase the highest pref they can find, thinking they're being super conservative. Well, in turn, they're actually doing the opposite. The deals that have treated me best over time rarely have the ones with the highest numbers overall in the pref structure. They're the ones with clean structures, experienced operating partners, and prefs that actually match the underlying cash flow. I'd rather have 7% and totally understand it rather than 12% that comes with complexity I have to go, truly dig deep to understand. Two scenarios. Let me show you how different the same number can feel. Scenario A. You invest $100,000 into a stabilized apartment complex. It's already leased. Cash is flowing. The deal itself offers 8% preferred return, and that's paid current, right, in quarterly distributions. The Waterfall is investor friendly. Pref first, then return of capital, then the sponsor participates in the upside. Every quarter, you're getting a check, roughly $2,000. At the end of year 5, the property sells, you get your capital back, then your share of the profits. This is relatively straightforward, and the pref is doing exactly what you expect it to go do. Scenario B, that same $100,000, same 8% pref, but this time it's a development deal. There's no cash flow for 3 years while it's being built. The pref is accruing on paper, $8,000 in year 1, $16,000 in year 2, $24,000 in year 3, and so on. The waterfall is different. Once that project sells, profits are split 70-30. The sponsor before your capital is fully returned. When the project finally sells in year 5, you're supposed to get your $100,000 back, all the accrued pref, but the sponsor are taking their 30% of the upside, even though you haven't made whole yet. If the project sells for less than expected, or it takes longer, which definitely happens, or costs more than budgeted, your accrued pref might not be fully covered, and the sponsor may have already taken distributions. You were first in line, but that line led to a smaller piece of the pie than anyone had planned on. So same number in terms of pref, very different experience overall. When I'm evaluating a deal, these are the questions I actually ask, right? I don't start with, is this pref high enough? I start with 5 questions. 1, is it current or is it accrued? Am I getting paid along the way, or am I waiting till the exit? And how confident am I in that exit? And there can be some combination of both, right? Some current, some accrued, right? Understand that's really crucial to model your cash flow in your portfolio. 2, what's supporting it? Is there actual cash flow behind this pref, or is number on paper? Right? A pref on a stabilized asset is very different than a pref on a deal that has to go build it in the future, right? Also, understand where the cash is actually coming from, right? There are deals that raise capital to go pay a preferred return. This is something you need to go look at, as well as where that pref and cash flow is actually coming from. 3, what's the waterfall structure? Does this sponsor wait until I'm whole, or they participate in the upside while my capital is still at risk? And in that case, can I claw it back if that deal underperforms? This matters more than most investors actually realize. 4, what happens if the pref isn't met? Does it compound? Does it disappear? Are there clawbacks? Right? The clawback component is very, very big here. What this means is that will the sponsor, if they take their 30% of the upside, give that back in the case that my initial capital and pref aren't hit in the future? 5, how does this all affect incentives? Is the sponsor aligned with me, or are they incentivized to take a risk in my capital? The structure will tell you more than anything else. Like Charlie Munger said, show me the incentive, I will show you the outcome. In video number 1, we talked about capital having jobs. For the capital you've allocated to predictable income, the bucket where you want to know what's coming, preferred returns are one of the main mechanisms that determine how that income actually gets structured. But the pref is just one piece. The waterfall is the whole system. Understanding both is between reading a deal memo or an OM and understanding what you're actually buying. A preferred return is a tool. In a well-structured deal, it can create real alignment. The sponsor doesn't get paid until you do well first. In a poorly structured deal, it's a great marketing play. A headline number to help make you feel really strong with something that may not be that great. The difference is always in the structure. And now you know what questions to ask. In the next video, we're gonna go much deeper on waterfalls, the catch-up provisions, the clawbacks, the place where sponsors can get creative, but that's where the real incentives live. See you there.